For many retirees today, a Roth conversion can make a lot of sense. Now, if you have a pension, it may make even more sense for most people we're seeing right now. And so today we're going to talk about 5 reasons why you should do a Roth conversion, especially if you have a pension.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
With today's lower tax rate environment, we're seeing a lot of people that are doing Roth conversions, especially those who have been diligent savers, those who have more saved up in those tax-deferred investments, those 401ks, those IRAs, all of that money you've been saving all these years that when you take out money from those accounts, you got to pay taxes. And so what we're seeing people look at right now is, do we want to pull that money out now, or do we want to wait until we're forced to take that money out at what's called required minimum distribution age, which happens at 73, or 75 if you're born in 1960 or after, your age is 75. And so with those things to be aware of, should we be looking at moving money now from our tax deferred over to tax free, which can be considered a Roth IRA, and pay that tax now at lower rates and also before this investment grows over time? So high level, that's the concept of what a Roth conversion is. And so one of the big reasons why that we're seeing people with pensions do Roth conversions is because they're expecting to always be in a higher tax bracket. They're always expecting to be in the same tax bracket they are now, or potentially higher in the future. And the reason why this is because when you put a pension, and then you put Social Security on top of it, and then you put investment withdrawals, those RMDs we just talked about, then you may end up in a higher tax bracket than even when you were working with all of that. Your pension's already going to start you out at a higher tax bracket, and that's going to mean that you're going to pay more in taxes on each investment withdrawal that you make. So even if you don't expect to be in a higher tax bracket, you may end up in a higher tax rate because the rates will likely increase over time. We already know that's going to happen in 2 short years in 2026. Due to the Tax Cuts and Jobs Act. So what's going to even happen beyond 2026 is a question that we're having a lot of people ask themselves right now. So if you have a higher pension, you may always be in a higher tax bracket. Do we want to pay our taxes now or later is ultimately the decision that these people have to make. And so that's one of the main reasons that we're seeing people do Roth conversions with pension. The second thing that we always want to make sure people with pension understand is IRMAA. Right? The Medicare premiums per Part B and D, that's going to be based on your income. So the higher your income, the more you're going to be required to pay for health care and retirement. Now, I personally don't think that is fair. I think that is penalizing people who have been good savers over time, the people who have had worked for a long time and accumulated a great pension. Those people are going to have to potentially pay more in Medicare premiums, but get the same coverage. And so we want to make sure you're aware of that you're going to be close to those tiers with your pension and then your investment withdrawal, Social Security, as we've just talked about. And so a Roth conversion can ultimately reduce your income in retirement while still living on the amount you want to live on by taking out money from tax-free and other vehicles like that. But this could mean that you could pay less in Medicare costs over time, which could be pretty significant. You could pay 2, 3, 4 times the amount in Medicare costs if you do not plan the right way. And one strategy we're seeing many people utilize is this Roth conversion here. So that's the second reason. The third reason why we're seeing people with pensions do Roth conversions is because of the Social Security tax torpedo. Now, this one is very complex, but it's important to understand. And so we have to understand with Social Security that is not taxed to everyone who receives a benefit. So if you receive $100,000 from Social Security, you could have all of that tax-free potentially. Or you could have up to 85% of that $100,000 be counted as income. And so that's what's called where provisional income is to determine how much of your Social Security is going to be taxable as income or not. But the most it could be is 85%. The least it could be is 0%. And what we see with people with pensions is they're not going to be in that 0% category because their pension's already pushing their provisional income too high to where they're going to have to pay tax on the Social Security. And then the next question becomes, how much tax are they going to have to pay on the Social Security? Are they always going to have their Social Security fully taxable? If so, this may not be something you can plan for, and you're going to always have to understand that that's going to be the case. But for many people we see, we can back their income down below what we call this Social Security tax torpedo. So I've wrote an article here. It was featured in Kiplinger on this torpedo, and I think the title of the Kiplinger is Will You Pay Higher Taxes in retirement. And in this concept, I talk about the fact that if you hit this torpedo, you're likely always going to pay higher tax rate in retirement, because you could pay a 40 to 50% tax rate during this period of time as you reach that 85% of making your Social Security taxable. And so, for example, we had a client not too long ago where if they took a $10,000 withdrawal, that would have put them into the entire torpedo. If they took that $10,000 out, they'd have to pay about a 50% tax rate on that $10,000. That means they only get to keep $5,000, and the other $5,000 goes to Uncle Sam. I don't know about you, but I don't think that is a good use of our hard-earned life savings to see half of it go to Uncle Sam. And so if that's the case, we need to make sure we can be proactive and plan before this happens. And the way we do that is by strategies like a Roth conversion. Maybe we can convert it now at 12% or 22% or 24% or maybe higher depending on how much investable assets you have. But if we can do that, would you rather pay it at 24% or 50% during that period of time? So a lot of this is going to come down to where do you sit, where are you going to sit? Not only where you're now, but where we expect to be in the future when you turn on all these income streams of Social Security. When you get to age 63, when Medicare premiums are starting to be calculated, when you go to take out investments from your non-qualified accounts that count as capital gains, how does all of that play together is what we want to encourage you to look at as you make these decisions for your tax-smart income planning in retirement. And when to take Social Security is going to depend, right? Some people take it as early as 62, some people wait till 70. There's no right answer for that, but we want to make sure that we are analyzing what the pros and cons of each are. And we tell our clients to take it at every single age. It's just going to depend on their situation. But maybe you look to delay it till 70, do more Roth conversions until then when your income is lower, and maybe you can, at 70, take less out from your IRAs, or maybe it's all in Roth, or majority is in Roth at that point, and then you can plan from there. And just an FYI, we typically don't recommend everyone put their money towards a Roth. We don't recommend they convert everything. Typically, it's small amounts over a period of time to make sure that we don't get heartburn by doing too much, but we also are not doing too little to where we're leaving money on the table. So there's an optimal amount when you look to do this Roth conversion. So that Social Security tax torpedo is reason number 3. And so for reason number 4 here, we always want to make sure that people understand that if you don't need your RMD, well, then a Roth conversion can make a lot of sense. For example, we have clients with millions of dollars saved up in their tax-deferred vehicles, and they have a pension, and they go, we don't need this money. We want to leave this to the kids. We want to make sure that if one of us passes away, our spouse is going to be covered when that widow's penalty comes into play. And so if that is you, well, maybe you move it to a Roth, and then there is no RMD on a Roth. And so if you have it in a Roth, that's going to grow tax-free, and there's no requirement of taking that money out in the future. And so if you want to let that thing keep compounding and growing over time, I'm sure you've seen the power of compound interest over all the years you've been saving into these accounts. What if that can be compounded at a tax-free level? For example, let's say you have $1 million right now in a Roth IRA. Well, if you're 60 years old, by the time you're 70, that's going to be $2 million is what the Rule 72 says. That money will double in 10 years if you get a 7.2% return. And then at 70, it's $2 million. At 80, it's $4 million. And then at 90, it could be $8 million. If that's all in a Roth, that's all tax-free. Now, what if that $1 million is in an IRA? It's still going to keep doubling, but by the time you're 90, that $8 million is going to all be counted as taxable. And at what tax rate? We have no idea. Let's just assume a 25% tax rate. You're losing $2 million of that wealth just due to taxes. And that's assuming that tax rates don't, double or increase over time like some experts suggest. And so that's just the power of the Roth and that compounding growth tax-free. So if your goal is to leave money behind or leave a legacy to loved ones, well, then a Roth can make a lot of sense in those instances so that you don't have to worry about pulling that money out. Because what typically people do is they pull the money out, they pay taxes, and then where do they reinvest it? Well, they reinvest it in non-qualified accounts, maybe a stock or maybe a money market at their bank account. And if you invest in a stock, you're going to have to pay capital gains tax on any of that growth ongoing. You're going to have dividends. You're going to have a bunch of taxes each year that are going to bump up your income. And so that may not be something you want to face. And if that's the case, put in a Roth, you won't have to worry about those dividends being taxable and all of those other growth being taxable. And then if you put in a money market, for example, you're not going to have to pay capital gains, but you're going to have to pay taxable income on all that interest. And that interest is going to come due every single year. And now you're going to force your income higher throughout your retirement, force those Social Security, force Medicare like you talked about. And now you're putting yourself in a lesser situation and causing yourself to pay more tax when you may not have to. And so those are something we really want to make people clear of if that's their goal. And even if your goal is to leave money to just your spouse, I want my spouse to make sure they're good to go. Well, it may be wise to not have that RMD so that money can grow tax-free for them if they need it in the future. Could be very valuable because, as we always emphasize, the widow's penalty is very severe. When one spouse passes away, there's two big things that happen. One is Social Security goes from married filing jointly to single. And then the other big difference here is that your tax brackets will go from married filing jointly to single. But also, you're going to lose the Social Security, which means that that's going to be a double penalty there from a widow's penalty standpoint. And that can be pretty significant. We're seeing people $30,000, $40,000 that their spouse is left without of income due to tax and Social Security. That, hey, if we can get ahead of that, that may put them in a better situation where they won't be in as high of a bracket. They can pull from the Roth, the tax-free, that's been accumulating over all those years as a consideration. The fifth reason why we recommend a Roth conversion with people with pension is simply because of that widow's penalty that I just explained. And it can be very, very severe, especially as things progress moving forward, especially for those with diligent savers. We always say this in a lot of the videos we do, that the people we work with, they typically have more saved up, which means that you have to really think more advanced. The cookie cutter approach that may have got you here may not get you there. Getting up the mountain, it's all about saving. It's all about accumulation. It's all about making the right decisions and being diligent. That's great and that's important, and not everyone's good at that. So if you've done well there, congratulations. You've done a great job up to this point. But what we typically say is, hey, you may not need more money right now. You may just need a better plan. And so if that's the case, well, then if we can start getting ahead of these things and start to, with these diligent savers, start to be more strategic with the plans that they're putting in place, it's probably going to leave us in a better position where we can save hundreds of thousands of dollars in taxes is what we're typically able to see with the people that we work with. And so those are the 5 reasons, the 5 things that we suggest that you should look at with a pension. If you are looking for more content or more education on pensions, our 2 top viewed YouTube videos. So if you just go to most popular on our YouTube page, you'll see that those 2 are there. And one of them is how much is a pension worth? And it's pretty shocking to see, there's only less than 20% of people who even have a pension now. So if you're listening to this, just know you're unique and know that you have a great opportunity there. It's going to be harder from a tax planning perspective. It's going to force you to pay more in taxes if you don't plan the right way. The good news is if you plan, then you're going to be fine. But also understand that that's a lifetime income to you that's pretty significant. And there's a reason why they're not offering it anymore is because it's so attractive. And it's so hard for these companies to fund and keep them funded moving forward. And that's why even if companies are offering pensions, they're typically reducing the amount they have there. So that's something you want to look into, is watch that video just to give you confidence of what you have there. And then the second video is purely about tax planning with pensions and what you need to be aware of there with pensions. And so, many things here we touched on as well, but that's going to really go more in depth into what we're talking about here today to ensure you really have the right plan in place, that you're not paying more in taxes than you need to. And obviously, I wrote the book called I Hate Taxes. It was an Amazon bestseller. So if you're looking for more resources on that, I'd highly suggest that you request that book as well. And you can actually go to our description below and you can actually request a copy there, and we can send you one out to make sure that you get that in your hands. I didn't write that to make much money on it. I wrote that to try to get it in as many people's hands as possible. Obviously, you can tell from the YouTube channel, we just want to give out as much content as we can, make sure people are educated. We can't work with everyone, obviously. We don't have the capacity to just work with every single person that knocks on our door. And so this is a way that we can continue to help as many people as possible while still making sure that our clients get that level of service that we promise them is ultimately what we desire. So those would be some helpful resources there for you. If you would like to schedule a time with our team, if this is a type of information that you're looking for, or maybe you feel like this really, the type of planning we do is specifically for someone like you, then go ahead and reach out to us. We can have a conversation to see where you're at and see if we can help. And if so, then we could explore further what that could look like. But if not, we'll at least make sure you got the right guidance to, get help from someone else that we feel may be a better fit. But just know that that's always an option there for you. So with that being said, I'm going to go ahead and wrap up today's episode, and we'll look forward to seeing you on the next one. And I hope you enjoyed this. And again, if you have a pension, understand that you're in a great position, and now you just have to continue planning to make it even better. So have a great day.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.